I should mention as well, on the economic front, we just got some numbers. The Institute for Supply Management's manufacturing index, it did fall month over month in November to 57.5. Perhaps more notably, the employment gauge, the employment subgauge of that, falling into contraction. So it's, I believe, at 48.4, below 50 signals contraction. So even though manufacturing still above 50 and relatively robust, the employment portion of that perhaps flashing some warning signs. Let's talk more about the economy. Let's talk more about what to expect from Jay Powell and Steve Mnuchin. We're joined now by Michael Kushma. He is Morgan Stanley Investment Management CIO of Global Fixed Income. Michael, it's always good to see you. When we listen to Jay Powell sort of try to thread that needle and be cautiously optimistic, as Brian Chung just characterized his commentary, what are we then to read into that in terms of future monetary accommodation?
It's a very good question, because I think what's most policymakers seem to have learned from the global financial crisis is that policy was tightened, or a combination was reduced too quickly post the economic recovery, which then generated a very mediocre, long-dated period of time where we didn't get very fast growth. So I think that what they want to emphasize is that policy will remain easy, accommodative, for as long as it takes to get employment and the economy back to where it was in 2019. The argument will be, well, when is that going to happen? How close do we have to be before we start talking about removing accommodation? I think the Fed has been clear that they do believe they are providing lots of accommodation right now. The big question is, will things have to get worse in the short term and have to do more, or can they just stay the course for a long period of time?
Michael, I talked to some of my friends on the street, and the consensus seems to be that it's no longer acceptable that the Fed just sits on low rates and that's all they could possibly do to boost the economy. What else could they do? What other strategic ways could they help boost the economy if lawmakers are not going to provide that fiscal stimulus?
Well, one thing which they can do is prevent the old-fashioned bond market vigilantes from pushing up long-term rates prematurely. Right now, a good measure of financial accommodation is the level of real interest rates, and the real interest rate on U.S. Treasuries are negative. So that is a good signal that monetary policy is easy today. What they want to really ensure is that over time, as the economy gains steam, which it hopefully will starting sometime early next year, when vaccines are rolled out, we'll have a very strong recovery next year, is that they keep real rates low. So what they can do is engage in an adjustment of their quantitative easing strategy, their long-term asset purchases, and switching the maturity composition from shorter maturity bonds to longer maturity bonds as needed to ensure that there's no premature tightening of financial conditions such that would jeopardize the eventual recovery, or as fast as reasonable, the recovery of the economy in 2021/2022.
Mike, when you look at fixed income right now, and especially you see what's happening along the Treasury yield curve, and we're outlining a hypothetical swap here, I guess another Operation Twist of sorts. But as it stands today, based on the shape of the curve and some of the dynamics, especially on the longer end, what is that saying to you about investor expectations for the recovery? We have the equity indices today basically at record highs. Equity investors are excited about the recovery. Does fixed income, or do fixed income investors seem as enthused to you?
I think you have to look at different parts of the fixed income market, but you're right. The Treasury market yields are very low relative to the recovery we've seen in equities, and more importantly, in corporate bond yields and corporate bond spreads. And the Treasury market is being strongly influenced by Fed policy and the cumulative and current and ongoing effects of quantitative easing. They are absorbing enormous amounts of treasuries every month, and mortgage-backed securities. I think it's approximately $120 billion a month they are buying every single month. And that is impacting the shape and levels of the yield curve. So the yield curve, I do not think, is a good indicator of the consensus expectations of where the economy is going down the road, because investors are leery of the Fed not wanting or allowing even long-term interest rates to rise. If you look at other areas of fixed income, like corporate bond spreads, the high yield market, it is rolling along kind of like equities, in the sense that corporate spreads now are as tight as they were at the beginning of the year in many sectors in the pre-COVID world. And the high yield market has recovered quite nicely, where the positive returns for indexes as a whole, even though the real COVID impacted sectors and some of the more cyclical sectors are still struggling a bit.
So, Michael, does that mean we could end up with sort of an unusual scenario, although it's become less unusual in recent years, where we do see a robust expanding economy, where even perhaps we get that fiscal stimulus and rates still remain pretty low?
I think that's exactly right. It doesn't mean yields can't go up, but they're going to lag the recovery so that financial conditions will stay easy. So as the economy expands and grows stronger next year, it's certainly possible that long-term interest rates rise, but they're going to rise at a fairly slow pace, if at all, depending upon, of course, the ebbs and flows of the economy next year.
Michael, potential incoming Treasury Secretary Janet Yellen. The general consensus out there is that she will be very aggressive on spending, spend, spend, spend. How might that impact the fixed income markets next year?
I think that it's going to be positive for credit markets in the sense that anything that has credit risk, default risk, a stronger economy is quite positive for those sectors, and they'll do well. Real estate markets should do better because of that. On the other hand, risk-free assets or defensive sectors of fixed income, which are much more interest rate sensitive, will face some upward pressure simply because of the cyclical momentum in the economy. We've seen the Fed has been calling for more fiscal support for the economy, to take pressure off the Fed. So I think what the Fed is fearful of is being asked to do more than they're currently doing. I think they're happy to keep the combination that they've generated so far, like keep it in place for a long period of time, but they don't want to be asked to do things they can't really do. I mean, put money in people's pockets. They can't do that. They can keep financial conditions easy, but money has to be put in people's pockets, in particular for sectors of the economy which are still lagging the recovery.
Yeah, you can throw all the money out of a helicopter if you want. You can't necessarily determine where it will end up, to your point. Michael Kushma, thank you so much for being with us. Always great to talk to you. Morgan Stanley Investment Management CIO of Global Fixed Income.